welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. I'm Chris Preston, Cabot's Vice President of Content and Chief Analyst of Cabot Stock of the Week.
And I'm Brad Simmerman, the web editor and the Chief Analyst of the Cabot Wealth Daily. This week, format's going to be a little bit different. We're not going to start off with a hot take. Instead, we've got a segment where we're going to dust off the crystal ball. And since we're at the midpoint of the year, we're going to make some predictions for the rest of the year. But before we do that, we're going to get into our normal big three. We're going to talk about consumer confidence, the revenge travel summer, and the impact that's having on travel stocks. And we're going to talk about the aborted coup in Russia. I don't know that we're going to have a ton of financial insights from that, but it seems worth discussing. I know Chris pulled some information. First, though, happy Independence Day, everybody. I hope you enjoy the freedoms that living in this country affords us.
Yeah, wow, that's very patriotic of you. Hopefully people get, I know Cabot gets the extra day on Monday, so hopefully people are able to take a nice long weekend there and get out and do some spending, which dovetails nicely into our big three. As you mentioned, Brad, number one, consumer confidence is now at a 17-month high. The most recent numbers that came in, it was 4.2%. Consumer spending was up 4.2% in the first quarter. This is revised numbers for Q1. That was the highest since second quarter of 2021, so nearly 2 years. That was part of the 70% of GDP, which was also revised up, is consumer spending. This is been the most positive earnings surprises since early 2021, so similar timetable. And Brad, you had some interesting stats from Yardeni about baby boomer spending that could give some insight as to the kind of spending that's happening right now.
Yeah, so I personally, and I know you have in the past, used the Yardeni research resources pretty liberally. I find that they have an excellent track record. They're easy to use, easy to understand, fully endorse it. But there was recent commentary from that group saying that there is a hidden vault of spending power that we haven't tapped into yet. And to put it bluntly, it's the baby boomers, right? Yep. Baby boomers are entering retirement age. They have 75 trillion estimated net worth. It's the largest. It exceeds all other generational cohorts. They're entering a point in life where they're either going to have to start spending it in retirement, or they're going to have to start passing it on to heirs who will then immediately re-inject it into the economy. So excess spending or excess savings in the pandemic was $500 billion. That's buoyed the economy through what was supposed to be a recession for the last 2 years. Imagine the impact of 75 trillion of spend. I'm about to commit the greatest journalistic sin in that I read a great line, but I can't remember where I saw it. So yeah. I can't attribute it to anybody, but it
fits our pod ethos well. Yeah, go ahead.
I think it might have been in the Atlantic, but a comment was made trying to distinguish between, okay, well, are we going to have a rich session where high spenders downgrade to Dollar Tree? Are we going to have a spend session? The line was, if you have to call it different names, it's not a recession.
Yeah,
that was my big takeaway, and obviously the baby boomer excess savings are going to trickle into the economy over the coming years and decades. But a rolling recession where maybe the consumer starts weakening a little bit, but the retirees start spending more, it could be enough to lead us to that soft landing promised land.
Yeah, I'm going to save most of my comments for when we do second half predictions, because I may have some recession related stuff in there. And as I think my defend the take a few weeks ago was that there will be no recession in the next year. And we just keep getting numbers that support that. Consumer spending is part of it, but the recent GDP numbers, which is, again, that's only 70% of that is consumer spending, but not all, supports that theory as well. So basically, all is well in the economy, and that leads to number two in our big three. There's a particular area where that's surfacing.
Yeah, yeah. So in the last month, in the month of June, airlines, absolute killer performance as the group as measured by the Jets ETF up 16%, United up 13.7% just in the month of June, Delta up 28.8%, American up 20%, JetBlue up 30%. And year to date, both Royal Canadian and Royal Caribbean, Royal Canadian would be a much different company, and Carnival Cruise have doubled this year. So we are finally seeing the impact of this pent-up pandemic travel demand being unleashed. It's finally happening. The airlines were screaming for the past couple of quarters that they were doing better business than anybody had expected, that they were going to beat earnings expectations. Nobody believed them, but it's finally started trickling into the bottom line, and airline stocks are thriving right now. And I think they're probably early in the travel bull market. I think that's a sector you could definitely look at. In Cabot Money Club, chief analyst Nancy Zambell recently wrote a feature that was just published today about how to save money while ticking items off your bucket list, and also highlighted a few travel stocks that she likes. But I think it's going to be a really interesting sector. I think there's a lot of room for these companies to continue to beat expectations. Royal Caribbean and Carnival both still trading below pre-pandemic levels. Airlines are more of a mixed bag there, but there's a lot of room for improvement. You look at a company like ULCC, which is Frontier Airlines. They're trading they're trading up significantly in June, but they're not really that far off their recent lows.
Yeah, I've got the Jets ETF chart up right now. That's basically a fund that is a proxy for the airlines. It, despite the run up, 24% year to date, is trading about a third of the price that it was before it fell completely off a cliff in January 2020, so right before the pandemic. It was up to 32 in January 2020, and it is now at 21. So there's still some value there. I know value hasn't been a great year for value investing, but this is like a value plus growth because, with all the spending, like you mentioned, that baby boomers are spending. There's a rush to travel in the post-pandemic life. Frankly, I saw it last year when I went down to Nashville, where our producer Madison Robertson is from, and I couldn't believe how packed the airports were. Last July, probably even more so. I haven't flown yet this spring/summer. I'm guessing even more so now. I think there's still room to run for these airline stocks because of the growth that's ahead, and because they're still trading at only about 2/3 of their pre-pandemic prices.
Yeah, especially if the sort of much heralded recession doesn't arrive. I mean, okay, if we hit a labor recession, which right now, we're not, labor demand is still really, really strong. If we hit a recession that ends up hitting the consumer, all right, maybe people start putting travel back on hold. But with everything that we're seeing now, I'm bullish on travel, at least through this summer. The perception element of it maybe slows down as people get into the winter months and stop traveling. It stops being front of mind for investors. But I think it's a powerful sector right now and something worth taking a look at.
Yeah, I mean, all across Cabot Advisories, not just airline stocks. There's casino stocks, especially in China, which reopened more recently. There's some cruise stocks in there. I think you just wrote that, was it 2 of the 5 or is it 10 best stocks? I think it was 5 best stocks of the first half, best performing stocks first half of the year were cruise stocks, right?
Yes. Yeah. Two of the 5 both had doubled. One other item, Airbnb up 17% this month. It's up 51% year to date. I don't love Airbnb as much. I just have a visceral response to the idea of renting out somebody else's house. But maybe if you
Did you have a barbarian experience?
I
For anyone
thankfully,
who's seen the 5 people who've seen Barbarian, the movie Barbarian, that are watching this, yeah,
that movie is great. I'm sure more than
I,
5 of our viewers have. Well, maybe not. All right. If you're the guy that has seen Barbarian and is watching this, shoot us an email. Do we have streetcheck
oh
at
yes, oh, yeah,
cabot.com?
we should, yeah. Don't we have the Cabot
It's
streetcheck.com
streetcheck at cabotwealth.com.
streetcheck at cabotwealth.com. Excuse me. Yeah.
Yeah, shoot us an email. We would love to get questions. But let's move on to the third post, or to the third member of our big three. This is one that I don't have a ton of insight on, but you had flagged that Bruce Kaiser of Cabot Value Investor had written about the Russia invasion of Ukraine. What did he have to say?
Yeah, so this is something we haven't talked about. Obviously, there's a war going on in in Ukraine, Russia-Ukraine. It's on a year and a half in, just about. Mostly U.S. investors have been, have shrugged their collective shoulders to this. Over the weekend, though, was the first big development in a while where Yevgeny Prigozhin and the Wagner Group, which is apparently a thing. I didn't know that till this weekend. He's a formerly close ally of a longtime close ally of Putin. He's become disenchanted with just the way the war is going there, and they staged a coup, and then it ended about 48 hours later. Here's what Bruce wrote about it. It seems highly unlikely that we will ever learn the details of the coup ending negotiations. More important, however, we have no idea what will happen next. Perhaps nothing will come of it, with Putin remaining in power indefinitely. Or perhaps Putin's display of weakness will lead to his overthrow by someone else. If so, what will happen to Russia? Will the now alienated country seek to repair its relationship with the West, withdraw its forces from Ukraine, and bring an end to the oil, financial, and other sanctions, as well as foster a resurgence of business and financial ties? Or will it assert even stronger anti-Western resolve and a more skilled and more powerful effort in Ukraine? Perhaps an overthrow would lead to rival factions battling for control, but leave the country in chaos. Each of these 3 generic scenarios has a very different outcome for the planet's economies, geopolitics, and capital markets. About all we can say for sure is that the range of outcomes is now vastly wider than it was last Friday. Almost bizarrely, however, there is little that investors can intelligently do in response to the blunted coup attempt. While the range of outcomes is exceptionally wide, the predictability of any particular outcome actually happening is essentially zero. About all we can suggest is that investors continue holding attractive stocks and not get too caught up, at least for now, with the goings on in Russia. I mean, I think I can't look at any other takeaway, considering, the markets, there was no reaction really, U.S. markets at least. Again, there's just U.S. markets. On Monday after the coup attempt, there's no, rush to, let's buy stocks. Russia might be overthrown. I don't think there was, other than maybe the first few weeks after the war began, February of last year, I don't think it had much of an impact, again, on U.S. stocks. European stocks, I'm sure, is more profound. It's just during the bear market, which, was going on until 6 weeks ago, it was always delivered as an excuse or a reason for why stocks were down, among a litany of things. Fed interest rates, top of the heap, inflation still high, possible recession. Oh, and there's a war going on in Europe. Do you see it as anything more than that, regardless of what happens here? Maybe not regardless of what happens here, but aside from anything really extreme happening here?
So I do think that we got lucky in that, as much of a tragedy as the invasion is, and as much of a travesty as what Russia's doing is, we're an investment podcast. We're just looking at that angle, but of course, all the calamities that happened there, that goes without saying, horrible. We wish it wasn't going on. We at least in the U.S., it seems like we sort of lucked into avoiding a lot of the worst predictions, right? There's concerns about restrictions on exports of Ukrainian grain. I think 30% of wheat exports came from there, or 30% of fertilizer inputs. I don't have the exact information, so I apologize.
Yeah.
Concern about energy prices was significant, and it maybe tracked through to Europe a little bit. But one thing that Tom Hutchinson, who chief analyst of Cabot Dividend Investor Income Advisor, has written is that Europe had an unseasonably warm winter, so lower natural gas availability was less of a problem.
Yeah.
Obviously, when you've got an invasion, there's a rush to hard assets like gold. But a lot of the worst outcomes turned out to be more signal than noise, or I'm sorry, more noise than signal. It didn't really have a material impact on the US. And barring something like an expansion of the conflict with NATO, or, God forbid, deployment of nuclear weapons, or, something along those lines, I don't see where this has a material impact on US equities. Europe, obviously a different story, but I think the Brexit scenario has already sort of kneecapped the UK. So I don't know that they're being harmed more by the invasion. They've got their own inflationary fight that they're having right now, and their own issues with BOE and pension liabilities that they had been working to address earlier this year. So I don't see a lot changing. I mean, maybe if there's an end to the war that's favorable, Russia withdrawals, puts new leadership in place, and opens their arms to the West, right? Maybe Russia becomes an attractive investing opportunity.
Maybe you buy low on Gazprom neft. That's still a public thing? I remember that I went to the Value Investing Congress in New York about a decade ago, when Russia was, not nearly concerned, or much tamer than they are now. And so that was one of the analysts' top value propositions, was Gazprom neft, but I imagine he's not recommending that now. I remember right after this happened, wheat stocks getting a big push, and I remember writing about that, saying, now's the time to buy wheat stocks, and I think same with oil and gas, but it was pretty short-lived. Any major change there could have an effect there, but barring the extremes that you mentioned, I think we'll just US investors have the luxury of continuing to go about their business with occasionally reading a headline there and saying, isn't that horrible, and then going back to their trading screen.
Yeah, I mean, so look at the Tucrium Wheat. I don't know if that's the right pronunciation. Wheat Fund, WEAT.
Yeah, that's the one.
February 25th, it was trading at 811. March 4th, it was trading at 33% higher, and it traded at those elevated levels until July of last year. But since then, it's essentially just been trending lower. We're not seeing real world impacts of real investing world impacts of the conflict.
And obviously oil prices have pulled way back. That's not an issue the way it was a year ago, last summer. Okay, so we probably that's our Russia bit for this year. And something
barring major news.
Unless there's a successful coup or end to the war or something. Should we move on to our featured segment?
Yeah, let's do that. So one favorite saying at Cabot is that nobody can make any predictions, and if asked to make a prediction, you say, sorry, my crystal ball is in the shop. And it's because we have experience analyzing stocks, we have market experience, decades of it, but you can't make a prediction. Nobody knows exactly what's going to happen. You can lean on your experience and make an educated guess. We're going to take all that careful thought and we're going to throw it out the window. And Chris and I are each going to make 3 predictions for the rest of the year. Would you like to go first or second, Chris?
I can start things off because mine sort of a just broad mark. My first one's just sort of a broad market prediction. Remember, these predictions will likely be wrong. It's sort of like Brad's defend the takes. The shelf life is usually
counter indicator. Whatever we say, just do the opposite. You'll be in good shape.
My first one, the S&P, already up 13-14% year to date, will finish higher by the end of the year. But small caps will outperform by a wide margin.
Okay.
Small caps, the Russell
Hold
2000.
on. Hold on. I got to stop you.
Yep.
My first take, the S&P will be flat for the rest of the year.
Okay.
But the broader indexes, including the small caps, will be higher.
All right. Well, this is why.
So
I think
we're not
we've
going to
been
be making
listening to each other too much lately.
Yeah, we need like a buffer or a firewall. Yes, continue your thesis. I just wanted to jump on.
Yeah, I mean, now we can just tag team this first 2 points, I guess. I'm saying the S&P will be up. I don't think you said flat. I could see it being up within another 5% or something. I'm not seeing anything much bigger than that. I think there'll be more of a pullback here, especially once people come back from their summer vacations. I could see like a late summer or September pullback. But small caps only up 7.4% year to date. The Russell 2000 is. And our Tyler London, who runs Cabot Small Cap Confidential Advisory, has been saying, look, these are undervalued. They're trading at about 2/3 the value of large cap stocks. I don't have exact numbers in front of me. They were down in the doldrums really until the last month. As of beginning of May, small caps were down. No, middle of May, small caps were still down for the year. Actually, May 31st, they're down, less than 1% for the year. Now they're up 7.4%. Why have they taken off? Part of that's just the market's taken off, but small caps, AI has been driving this market lately, and there's a lot of AI exposure in small caps. And I think given the valuations, and we've talked about it a lot, 8 to 10 mega cap tech stocks have driven this rally this year, and those have probably reached the end of their or closing in on the end of their run for this year. But I think there's still appetite, especially now that it's a bull market. There's appetite for people want to buy stocks now. They're going to turn their attention to small caps, and particularly AI small caps. And I think up 7 point whatever percent right now. I think it'll be at least double that by the end of the year, if not much higher.
Yeah, I think you're right. One of the statistics that I was looking at was the performance of the S&P 500 equal weight. It's SPXEW if you're on Google, $SPXEW if you're on stockcharts.com. So that mutes the overperformance of the mega cap tech stocks. The equal weight S&P 500 outperformed the S&P 500 in the month of June.
Yeah.
The rally is getting broader. It's not a full sail ahead, everybody's taking off kind of rally, but we are accumulating evidence that the rally is broadening out. It looks like a lot of the risk on assets, issues like biotechs, crypto, stuff like that, it looks like they bottomed in March. One thing that I had looked at recently was the XBI, the Spider S&P Biotech ETF, bottomed March 22nd. Month of June, it was up. It was actually like flat, but XBI was persistently setting higher highs and higher lows up until the end of June, when it broke below that sort of support line. Higher highs, higher lows, that's the technical definition of an uptrend.
Yep.
What we would want to see is these risk-on assets probably find support at levels that they're trading at now and then rejoin the rally. That would be the next bit of evidence that I would look for. But I'm with you. I think the neglected risk-on assets, the small cap stocks, I think they outperform for the rest of the year as well.
Yeah. Okay, so we knocked out the first two right there. I'll go to my second one. So also something we and I have touched on recently. Predictions of a recession will fade, if not completely evaporate. The evidence just keeps coming in that we're not close to a recession. The new numbers, GDP revision this week, First quarter GDP was revised up to 2% in the first quarter. Estimate for the current quarter is about to close Q2, 1% growth. Now, granted, that's down for what it was the last couple of quarters of last year, but chances are that it'll come in higher than 1% because that's been the trend. It keeps coming in. The numbers keep coming in higher than people expect, economists expect.
Yeah.
Maybe we get a quarter of negative GDP growth, but every single number, we talked about consumer spending, we talked about the travel boom. I'm just not seeing it. I don't think there's going to be recession. You're already seeing the word recession fading, or at least people being like, maybe more mild recession, or maybe there won't be a recession. I think that'll turn into either people just not even talking about the possibility of recession towards the end of the year, or saying there won't be a recession.
Yeah, I think the sort of the recession, the devil's advocate recession talk remaining case will be if the Fed over tightens and starts. I don't want to even go so far as to say breaking things. If there's a couple more Fed rate hikes and then smaller banks come back out and say, hey, we're stressing, we're triggering stress levels based on our asset blend because rates are up another 0.5 percentage point. So we're taking losses on these securities in our portfolios, these fixed income securities. Maybe you get talking heads like us saying, oh, is the Fed going to trigger a recession? Are they trying to trigger a recession? I think there's a scenario where it comes back, but like I was saying earlier, if you have to call it a bunch of different things, it's not a recession. But shall we move on to?
Yeah. What's your second prediction?
Second prediction: Q3 earnings puts paid the AI hype companies.
What is it? Q3 earnings does what?
Will put paid. So my understanding of that term is that it means we'll sort of bear the actual fruit of all this AI hype talk.
Okay.
So we will see in Q3 the companies that came out hyping AI that would actually not have any impact on their bottom lines. We're going to see them pay the price. I think that's the end. I think that'll be the end of the noisy hype around AI. And I think that I think Q3, if we're going to measure it somehow, you're going to have way less earnings mentions in Q3. And in Q4, the only people talking about AI are going to be the companies that are actually developing AI and AI technology, like NVIDIA, or companies that are in the process of successfully integrating it into their offerings.
Yeah, I think that's right. Yeah, it's right now, last few months, there's sort of an I'm Spartacus situation happening where everyone says, no, we do AI. No, we have AI. Yeah. And I think they'll finally, I think you're right, they'll whittle down to like, all right, who actually benefits from AI? What companies actually? That'll show up. The numbers never lie,
Yeah. So we're looking at July or August is when most of these companies are going to be start reporting Q3 earnings. That's when we're going to see the mentions drop off. That's where we're going to see companies say, oh, yeah, we weren't able to successfully integrate it. Or, I mean, maybe it takes until Q4, but I think that we're on the precipice of seeing some of this hype tamped down.
Well, that leads very well into my number 3, my third and final prediction, sure to be wrong. Biotech will have less buzz, but its gains will nearly match. I'm not going to say beat, nearly match AI's for the rest of the year. Partly because of what you're saying, there's going to be not an AI comeuppance, but an identifying of who actually benefits. And I think that just the AI boom will slow, as all booms slow. But biotech, right now, the XBI that you referenced is trading at exactly half its February 2021 peak. It is flat for the year, but it's up like most things you mentioned, bottomed in March. It's up from 73 to 83 since March. That's even with the pullback in the last couple of weeks, along with the market. Our Tyler London, I mentioned earlier, has written about this a lot. Rich Howe, who runs our Cabot Microcap Insider Advisory, he's very bullish on biotech, saying just how undervalued these things are. You know, and we talked about it a couple of weeks ago with the need for healthcare, and there's all these things that have just been waiting in the hopper.
Yeah.
I think there's going to be an explosion, and you know, maybe not an AI explosion, but I think maybe more quietly, biotech will be the second best performing sector second half of the year.
Yeah, I like biotech for the rest of the year. My only caveat is I was reading in Fortune a couple of days ago, VC funding has been slowing really, really rapidly. People have not been interested in funding venture capital startups.
Yeah.
Early stage biotech is not venture capital precisely, but they swim in the same waters. I would prioritize biotech companies with lots of cash on hand.
Mm-hmm.
Mainly because anybody that's trying to raise funding right now, say you're in trials and you need another 6 months of data, and you need to have a dilutive equity raise, or you need to sell bonds or something, that's harder and more expensive. So I would prioritize biotech companies with a lot of cash on hand. And if you can find some that are trading at a negative enterprise value, which is something that Rich loves,
Yeah.
all for it. I think the negative enterprise value ones, you have to sort of build a number of positions. I don't think you can just buy one and it's a guaranteed winner. But if you can find some attractive biotechs with a lot of cash on hand, maybe trading below the value of that cash, so market value is below how much cash they have on their balance sheets, I think that's probably a promising place to look. I will jump into my third prediction. It is a similarly risk on asset, similarly sort of speculative, and it's hyper specific. I'm going to, like Babe Ruth, call my shot on this one. Bitcoin hits a $45,000 local top in the next couple of months, and then it closes the year below 20,000. It is very specific, but there's a reason. So I had previously written this year, back when Bitcoin was around 16,000 or so, how technical it trades. There's no fundamental value of Bitcoin. There's no earnings for Bitcoin. There's no revenue for Bitcoin. The only like actual metric is the Bitcoin halving, where they reduce the Bitcoin mined rewards. So there's more of an economic input for less Bitcoin output. But other than that, it just trades on price technicals. The last big run up, so prior to the 2021 top, Bitcoin's next bull market retraced 70% of its highs before setting a new low and then bottoming for a couple of months, couple of years. If that plays out, so similar type of scenario to the way it played out back in 2008, the way it played out in 2016, I believe, and the way it seems to be playing out right now, would put Bitcoin over 45,000 in the next couple of months, and then give that back and end up closing lower. I don't know how that plays exactly with general market sentiment looking much better, right? Maybe there's a case where biotechs run up 30% and travel stocks go up 30%, like where everything is frothy bull market and it overshoots. But if we have a rolling bull market, rolling recession, whatever kind of environment we're in right now, I like Bitcoin to run up a little bit more and then give back most of those gains.
Yeah, two thoughts. As the guy who, in one of my defended texts a month or so ago, said I thought Bitcoin would top 40,000. I think, I can't remember, it was 4 years in, but I said before oil would get $100 to $100 a barrel. I agree, it'll get above 40. I can see 45. I don't know that it'll pull all the way back below 20 before the end of the year, but as someone who is not a big believer in Bitcoin other than as a bull market play, I do think it will pull back probably below then eventually. I think the market will hold up well enough this year where it won't pull back that quickly, but I can see that happening sometime next year.
Yeah. I mean, we'll see. It's technicals are not predictive; they're entirely reactionary. But you can, with some room for error, you can try and extrapolate, right? Like Fibonacci levels. Yeah. That's just extrapolating past performance. But one trick that you can do if you're trying to predict a price is let's say when you're using Fibonacci retracement, you're looking at like the 25% retracement line, or 73 is the level, I think. You can say, okay, well, it's going to run up this high, then it's going to retrace to this level. If you bring the retracement level higher to the current point and say, okay, if this keeps trending up, how high is it going to get for it to then retrace back to the current highs? So you can try some little predictive tricks. I'm bullish on Bitcoin right now. I do think it'll come back, but we'll see. And like all our crystal ball predictions, these are guaranteed to be right, except for when they're wrong.
Right. And before we go, we'd be remiss if we don't both say how many interest rate hikes the rest of the year. I'll let you go first.
2.
You think 2? Okay.
No. So I did read that Jacob, something that Jacob wrote, Vince, Cabot Options Trader Pro. He wrote earlier today that the market was pricing in the possibility of up to 3 more rate hikes. So I think he moved my Overton window a little bit with that, and that's why I jumped on 2. Let's say 1. I'm going to say 1.
You should stick with 2. I like
all right.
boldness of 2. I've been saying 0 all along. I think it'll be 1. I'll say 1 because this way I'll be right either way, unless it's 2. That's why I want you to stick with 2.
See, that's the luxury of boldness. You can just be wrong every time, and it doesn't matter.
That's right.
So yeah, I'll stick with 2.
Yeah. Okay. And I think either 1 or 2. I just don't think it'll have the same negative impact on buying and selling that it has, for the past year and a half. I just don't think we've been asking, when will the Fed no longer be the market boogeyman? It's getting there. It might already be happening, but it's not.
I think 3 hikes seems insane to me. I don't think we see that. I could be wrong.
Does.
Your mileage may vary. 2 seems reasonable, but it also seems like a number where the market can look past it. And I think that, look, we're bull market again, equal weights, risk on assets rallying. The market is pricing in the expectation that the Fed's going to be off our backs sooner rather than later. Yeah.
All right. Well, with that, thanks everyone for tuning in to our 4th of July weekend edition of Cabot Street Check. We'll be back. Actually, no, you'll be back next Friday. I'm on vacation next week. You'll be back with Tyler London, who we referenced, right? Cabot Early Opportunities, Cabot Small Cap Confidential advisor.
Yep. Yeah, we're going to be talking second order thinking. I'll not go too deeply into the spiel. You're going to have to tune in next week to hear exactly what we talk about. But seeing the signal under the noise, seeing the trend behind the trend, if this is true, what else is true? Second order thinking. How do you apply it to investing? How do you identify opportunities that other people are missing, even though we should be seeing them? So, and smash that subscribe button.
Yes, please do. Always do us a favor. Do it in the kindness of your patriotic hearts this 4th of July weekend. Please do that as you're watching. Have a great 4th, everyone. You too, Brad. And Brad will see you next week.